any junior members watching? It's at least one. I'm not sure if Ruth is agreeable. Leopoldo has certainly agreed that we will conduct this with our usual open-ended discussion method. So if anyone has any questions or comments that they would like to ask while Leopoldo or Ruth is speaking, please feel free to chip in, and we'll let the discussion get started along the way. And then we can have further questions later on, and we will finish at 8 o'clock as scheduled. So because it's a discussion, anyone who wants to put their cameras on, you're most welcome to do that. We'll get a bit more feel for the community that is assembled here. So we have this very interesting topic, full taxation, the single tax emperor's new clothes, based on these fascinating papers from Leopoldo Parada and Ruth Mason. Ruth is at the University of Virginia School of Law, where she's been since 2013 as a professor of law. Previously, she was a professor of global commerce at the University of Connecticut School of Law, and has been visiting professor various places in Europe: Johannes Kepler University, Leiden, Université de Paris, Panthéon-Sorbonne, and at Yale Law School. Has been a national reporter for the US to the 2008 IFA Congress and for the 2014 European Association of Tax Law Professors Congress. And she also sits on the editorial board of the World Tax Journal, as well as being co-editor of the Kluwer's series on international taxation. Leopoldo Parada is originally from Chile. He is now at the University of Leeds School of Law as a lecturer in tax law, having previously had a visiting position in European tax law at the University of Turin. He's taught, he was teaching international and European tax law. He's also held positions with the IBFD and with Wolfgang Schön's Institute, Max Planck Institute in Munich. He received his LLB from the Pontificia Universidad Católica de Chile, his LLM from the University of Florida, and his PhD from the University of Valencia in Spain, which won in 2018 the University of Paris Best PhD Thesis Award. And just last year, he won the Tax Co-op 35 Leaders of the Future taxation list as one of the most promising tax policy enthusiasts, or policy enthusiasts, perhaps to put it another way around. So we have a wonderful pair of speakers and a wonderful audience. Leopoldo has some slides for us, so please take it away.
Okay, so first of all, thank you very much for the invitation, Ian, and also Eduardo, who contacted me the very first time to present my paper here, and also it's great for me to do it with the person who was inspiring the origin of this idea and everything that we will talk about today, which is Professor Ruth Mason. So it couldn't be a better scenery for actually presenting these ideas than today. Okay, so let me share then the full screen. All right. So let me try to say in the first place what was how this paper was originated, and it was because the tax literature, and starting with Professor Ruth Mason, but followed also by other tax scholars, endorsed this idea that the OECD base erosion and profit shifting project reflects and effectuate a full taxation, which is or would be a sort of international tax norm that could suggest that all of a company's income should be taxed in places where it has real business activities. And that sounds quite seductive and rhetorically is very interesting, but but I find that the concept in itself is still inconsistent. First of all, and mainly because it doesn't answer or doesn't say anything about where or who should finally be taxed. But on the top of that, it is also very over-inclusive and to a certain extent also instrumentalist, because the only purpose that I see behind the idea of full taxation, so this idea of taxing all of a company's income somewhere, is not only that it's only about legitimizing the use of coordinated rules, which rationale is exclusively the avoidance of double non-taxation or the complete absence of taxation or very low taxation that we find in many provisions today in the international tax community. Now, many of you could think, well, what's the problem with that? I mean, there is it's quite an innocuous approach to try to make companies to pay a minimum or something somewhere. And the problematic that I see is that it appears to be very unprincipled. So there is no clear guidance of why we tax more than we need to tax somewhere, which is also very risky, particularly for countries that they wish to attract real economic activities. And of course, indirectly or incidentally, we stigmatize the concept of double non-taxation as well. So, so in a nutshell, what I could say that the paper is about is a normative criticism. It's a normative criticism that starts from recognizing that indeed BEPS reflects and effectuate full taxation, but we need to be careful about endorsing now full taxation from a normative perspective. Okay, so before going into the idea of full taxation itself, it is necessary that we give one step back and we talk a bit about single taxation. And this idea of single taxation, which is quite satisfactory because it brings us to a perfect world in which we say, well, income in cross-border transactions should be taxed at least once, but no more than once and no less than once. So we have a perfect system where income is taxed somewhere. An idea that came from many years ago, very recognized scholars such as Professor Ruben Avellona was supporting this idea. And of course, the idea in itself, this idea of single taxation or single tax principle, give us the satisfaction of saying we prevent both the appearance of double taxation and as well of double non-taxation. The problematic comes because we have never been able to really give an answer to what is each one of these concepts, double taxation and double non-taxation. In terms of double taxation, for example, we tend to focus, or double taxation is mostly about how many times we tax a particular item of income, right? But the question should be, in the end of the day, at least from an economic perspective, how much is the tax burden in the end? So if we say a particular taxpayer will be taxed at a 30% rate, probably if that taxpayer is taxed twice with two rates of 15%, economically speaking, it will be exactly the same. So we of course, this leaves us, you know, the unsatisfactory part of double taxation. Double non-taxation is equally unsatisfactory because we say, well, double non-taxation is exactly the opposite than double taxation, so the complete absence of taxation. But we cannot explain, for example, phenomena like very low taxation. Is that equal to speak about double non-taxation? So it's not surprising for me, at least, that many commentators comes with additional elements, such as fairness or justice, very slippery concepts such as aggressive tax planning, in order to overcome this sort of frustration behind these ideas of both double taxation and double non-taxation. Now, when commentators say, well, the OECD-based erosion and profit shifting actually reflects and effectuate full taxation, so this idea of all of a company's income should be taxed somewhere, I say, yes, that is actually correct, but it also puts on the table the inconsistencies of the idea of single taxation in itself, which is given by the circularity in which we move around when we talk about single taxation. Because every time that we try to ensure that income is not taxed more than once, so it's not taxed multiple times, we create situations of non-taxation altogether or double non-taxation, which is actually what happened during many years before the OECD BEPS project. Now, when BEPS focus exclusively on avoiding situations of double non-taxation, we give opportunities to come back to create new situations of double taxation. Just to give you an example, think about the case of hybrids. Either hybrid entities or hybrid financial instruments. If we think in a transaction, for example, where there is an entity that is making a deductible payment to another country, where that same entity is considered tax transparent, we will have that one of the rules that should apply at first place because of action 2 is the primary response, which says that that deductibility should be denied. Now, if for any reason that payment is indeed not included in the other country, because that is what is triggering the application of this rule, but it is included in the let's say in the next taxable year, there is no possibility to overcome that. So if we took together, instead of having just one taxable year, a single taxable year, we took together year, I don't know, X and Y, we have that the idea of double non-taxation simply disappears. So considering this conceptual background from single taxation is that the concept of full taxation arises. Because full taxation is, again, this idea of taxing all of a company's income where at least one somewhere, where factors of productions are located, which I will try to prove in a minute that actually it's very difficult that happens in that way. There are three criticisms that I'm trying to raise in the article about the concept of full taxation. The first one has to be with the indeterminism of this concept, and this can be conceived in two ways. One is that full taxation, of course, it doesn't say anything about what is the proper rate to be applicable, what is the proper tax base where we should tax. There are some hints that we can take, of course, with the international tax community. We could say we are not satisfied with a rate too close to zero. We should consider tax base, consider financial accounts in general. But whatever we take is still, to a certain extent, an answer or not an answer to the question of where to tax. And this brings us to the second idea of indeterminism, which is more important, which is to say, Full taxation or single taxation is not a distributive rule, and that is it is in itself problematic, because without a distributive rule, what we have is countries, they move around the same inconsistencies of single taxation. So this is taxing multiple times what has not been sufficiently taxed, or not taxing at all, with the aim, of course, of avoiding multiple taxation. More importantly, I would say it brings us to an idea, or to a premise that we could say it is a sort of, we need to tax no matter where and how. So the new mantra of full taxation, if we follow it as such, it raises particular questions that we could link to the whole discussion that is going on today international, particularly when we talk about digital services tax. Full taxation is a very good justification for countries to go unilaterally and say, we need to tax because these companies, these big tech companies, generate profits that up to now remain untaxed. We can, of course, suspect the chaos that we can go into if we follow that idea. And of course, we should forget about a global agreement and the Pillar 1. The answer is very simple, because when we try to ask ourselves where to tax, full taxation is not giving us an answer. It's giving us an answer which is basically saying everywhere. Everywhere is possible to trigger taxation, because that is what is behind the idea of full taxation. All of a company's income should be taxed somewhere, but we don't know where. And that where is actually a more fundamental question that comes before that we agree that we have to tax. Otherwise, we have an empty box discussion if we don't take into consideration before the particular distributed rule that we will apply. The second criticism has to be with how over-inclusive is the concept of full taxation. And this is not something that should be discarded easily and saying, well, there are other concepts in tax law that are also very over-inclusive. GARs are very over-inclusive as well. So what's the matter? What's the matter that full taxation is not only about double non-taxation, but also prevention of profit shifting, tax evasion and avoidance, loopholes, aggressive tax planning. I see two risks on this over-inclusiveness. The first is about mixing up legal terms and bringing, of course, more uncertainty, more legal uncertainty. Every time that we jump into this very over-inclusive concept, we end up creating more legal uncertainty. And a good example could be what happened with the modifications of the title and preamble of the treaty model in 2017, where was included, this reference to no or low taxation through tax evasion and tax avoidance. So of course the question is, well, does that mean that now treaties should aim to prevent double non-taxation or taxation less than full? And my answer is no, not at all. It simply confirms that double non-taxation was never a tax treaty issue, but of course it may become a treaty issue when there is an abuse of treaties in order to achieve, parentheses, artificially, the outcome of double non-taxation. So in other words, when double non-taxation is the result of tax evasion or tax avoidance, whatever other interpretation would be beyond the BEPS mandate. BEPS started in 2013 saying that no or low taxation is not per se a cause of concern unless it is associated to artificial practices. But now what we have is a switch going into the direction of saying double non-taxation now should comprehensively be prevented, which is dangerous. The other risk I see from this over-inclusiveness of the concept of full taxation has to be with the fact that full taxation includes double non-taxation as a sort of a proxy for abusive practices. So someone could a priori conclude that non-full taxation could be equivalent to abuse. Let me take the example of aggressive tax planning for this, a concept that I qualify in the paper as a very slippery concept. I don't know what aggressive tax planning is, but I took this definition from the European Commission on aggressive tax planning from 2012 that says, aggressive tax planning is taking advantages of the technicalities of a tax system or the mismatches between two or more systems for the purpose of reducing liability. Now, that means that any transaction with or without economic substance that achieve double non-taxation might be considered as aggressive. If full taxation includes the prevention of aggressive tax planning, it wouldn't be a surprise at all that someone may say that transactions not achieving full taxation are also aggressive, whatever aggressive finally means. What is the consequence of that? A proliferation of anti-abuse measures that they could use full taxation as a sort of a irrefutable presumption. I know that this goes beyond of the paper in itself, because it is part of a sort of a construction of a theory of anti-avoidance. But generally, in anti-avoidance measure, we have presumptions, and most of them are refutable. The problematic comes when you have presumptions that are irrefutable, and that is precisely the case of full taxation. How actually you can refute this presumption is almost impossible. We can get back into this issue during the discussion then after Ruth's intervention. The third element that I think is quite problematic of the idea of full taxation from a normative perspective is how instrumentalist is this concept, because it serves, in my perspective, only one purpose, which is to justify the fact that countries, they use provisions that they trigger taxation in a country immediately, to the extent that other country did not do it before. So without any principle guidance, more than, of course, the pragmatism of assuming that all of a company's income should be taxed somewhere, right? So this is perfect justification for all these coordinated provisions, such as the anti-hybrid rules. The global anti-base erosion proposal is exactly going in the same direction. And again, some of you could say, what's the matter with that? What's the matter with being pragmatic? Pragmatism can solve many problems, and I do agree with that. But tax law is not only about pragmatism. Tax law, as any other area of law, is comprises values and principles that that to a certain extent may serve the purpose of shaping the law, protecting also taxpayers from arbitrariness, from discrimination. So we recognize that tax law is also comprises these principles and values, like ability to pay. Otherwise, we forget about that and we say tax law is just something completely different than any other area of law that works purely based on pragmatic problem-solving solutions. And we recognize that we don't need to even care about principles or rules that we need to follow no matter what. Excessive pragmatism can create problems for actually developing consistent tax provisions. And let me give you an example, not to be so theoretical here. If you remember, when came the whole discussion about the anti-hybrid rules in the Anti-Tax Avoidance Directive in 2016, the original proposal was to say, well, what's the matter with hybrids in general is the disparities among countries about the recognition of a company as such or a financial instrument treated differently as debt and equity in two countries. So what we do, we simply introduce a rule that says that countries should follow the characterization either of the entity or the instrument in the source country. That was originally in the ATAT in 2016. Of course, at that point, the pressure of the OECD to introduce linking rules. So this idea of denying a deduction in a country to the extent that income is not included in the other country, or taxing in the other country to the extent that the deduction was denied, and creating, this outcome linked between one country and another was prevailing at that time. From a policy perspective, it made more sense to actually implement the rule that originally was part of the ATAT, especially within the context of Europe as an internal market, and solve, by the way, not only the problem of the issues of hybrid, but also ensure single taxation if someone was concerned about that. But instead of that, we adopted finally the linking rules proposed by the OECD. We opted by the pragmatism that was trying to convince us at that point that it was the rule to be followed. So pragmatism, excessive pragmatism, can, of course, from a policy perspective, bring us to take decisions that are not very consistent from a tax perspective. Finally, pragmatism, in particular in this case of the full taxation, may ensure that income is taxed once, and I agree with that. But very unlikely will ensure that income is taxed where factors of production are located. And this is what you find in the example that I'm happy to come back to that later. But in this example of the global anti-base erosion proposal that is in the paper, with the 4 different jurisdictions, is a very good example to show that full taxation ensures taxation somewhere, but not necessarily where factors of production are actually located. I will go briefly to this part of the paper, which is basically it was an observation which I consider was important to include in the paper, basically because I saw in many parts by many commentators the idea that full taxation is a sort of international norm. So I said we should ask ourselves, what does that mean? Is an international norm, strictly speaking, from a legal perspective? So the first question, of course, was, is there any international norm that actually prohibits taxation more than once or lower than once? And of course, my conclusion was no, there is no prohibition either of double taxation or double non-taxation. But the question becomes interesting when we think about what happened with customary international law. Because in such a case, we have, of course, to go into the formation of custom and recognize that custom is this formula where you don't only need practice of a state, that is consistent for certain years, but also the idea that countries follow that as if it was law or opinion juris. And I have to say that in terms of tax law, international tax law, of course, there are a series of practices that we can recognize. Practices are, evolving all the time at the same time, at the same rate that they are disappearing. That's what we have, and there is no discussion about it. So the main issue will be to determine whether we have opinion juris, which is unfortunately something I cannot answer at this point. But I do believe that there are two characteristics of international tax rules that prevent the formation of custom, and they have to be with, first of all, that most of the international tax rules are ad hoc rules. So we cannot ensure today that what we are dealing with, and not even the more basic concepts of taxation, such as residence source, will be there in 40 more years, considering a time frame that is normally what happened in other areas of international law for the formation of custom. And the second is that we lack of let's say, a centralized discourse that could allow us to create an homogeneous space where we can say, yes, after certain years, custom has been formed also in our area. Okay, so to finish, I would like just to say that full taxation, and for those who didn't read the paper of Professor Mason, please do it. It's an excellent paper. It's a very well-written paper, and it's very seductive as a concept, full taxation. But before we fall in love with this concept and we say how great it is and how great we are doing it, with these coordinated rules and around the world, let's take, my invitation is, let's take one step back and try to see in front of our mirror if we are not looking to ourselves naked, but we don't want to recognize that because of our vanity, that this is not precisely the concept that should guide our international tax rules. So having said that, thank you very much, and I look forward to the comments of Professor Mason now.
Shall I respond, Ian? You're muted, Ian.
Yeah, unless anyone has any questions first before Bruce Mason goes ahead. Just before you do, we have a form for people to sign their attendance to, which is listed in the chat. If anyone hasn't signed that, if you would, please, that would be great to help us keep track of everyone. And yes, please, Ruth, go ahead.
Okay, great. So first of all, let me say, thank you to Ian and Eduardo for the kind invitation. I'm really delighted to be here to discuss the paper of my dear friend, Leopoldo Parada. And I really like this paper. We've talked about it a lot. Okay, so Leo's paper responds in part to a paper that I wrote, this Transformation of International Tax. You can find it on SSRN. In my paper, I argued that BEPS wasn't just a minor blip in international tax history, but it was a major turning point. And in part, I argued that the reason it was such a turning point is that it teed up the distributive issues that the countries are negotiating about right now at the OECD. But also as part of that paper, I made the descriptive claim, not the normative claim, that countries were starting to accept a new norm in international tax. So just as they had already converged on a norm to avoid double tax, so now they are converging, I argued, on a norm to ensure full tax. So full tax as a norm dictates that, now I don't know an exact definition, this is part of the problem with the concept, as Leo points out, and I agree, but the idea is something like all of a company's income should be taxed in the places where its real business activities are. Okay, so this term, full taxation, does not refer to a new idea, right? It's just, and I was just hoping to create a less awkward term than the term we were already using, like, double non-taxation or prevention of profit shifting, all of these sort of multi-word descriptions of what was going on. So, full tax is just half of Reuven Aviona's single tax principle, right? That has two ideas inside of it. One is no double tax, and the other is full tax, no double non-tax. So if you have both of these things, then you have Reuven Aviona's single tax principle, okay? So the idea of full tax that Leo's responding to, that's the idea, and then in my paper, I argued it's becoming a new norm. Okay, so the first thing to say about full tax is that whatever complaints you have, and I'm sure you have many, about double tax and its indeterminism and its lack of conceptual clarity, they also apply to no double tax, to full tax, okay? Because the ideas operate exactly analogously. We use both terms like they convey something, right, as if they convey something precise, but in truth, neither does, okay? So when you say something was double tax, what you generally really mean is that whatever countries taxed it, and no matter how many, it should have generated, this income should have generated an amount of tax T, but it actually generated greater than T, right? So we can even talk about double tax within a single country's tax system. And then when we talk about double non-tax or less than full tax, we're just saying, again, income should have generated T, but now it's generated less than T, okay? But the problem is that knowing T depends on how income should be, it depends on the definition of income, which depends on how income should be allocated across countries and what the tax rate is. And a lot of the time, those defining features of T are contested, they're in dispute. So, what I say in the paper about this kind of sum up. So at the same time that I'm arguing as a descriptive matter, the countries are adopting full tax, I don't in the paper endorse that the countries ought to adopt full tax. And where I come down on full tax in the paper is, so what I say is, unfortunately, right, like its foil, no double taxation, the concept of full taxation is underspecified. While the notion that a company should be subject to full but not double taxation seems unobjectionable, because there's no global benchmark for defining taxable income, and because there's no ideal tax rate, views diverge as to when those standards have been met. Okay, so I describe this in the paper as the lack of a distributive rule, but unlike the OECD's no double tax principle or no double non-tax idea, Reuven Aviona's single tax principle does have a distributive rule, okay? So he uses as his distributive rule the benefits principle. The problem with that is that, and Reuven Aviona readily admits this, right? He recognizes it, is that the benefits principle itself is contested. So even if we all agreed, right, that the benefits principle ought to be the distributive rule, then we would just disagree about what constitutes a benefit and how the income gets allocated. So, one thing to say, and you can say it about both the concept of double tax and the concept of full tax, these ideas, as terms, not as norms, is that they're imprecise, but they still give a name to something important. And most of the time we can live with this kind of imprecision. And we ought to be able to live with it in full tax at least as well as we can live with it with double non-tax or with double tax. Okay, so when I say double tax, you know what I mean. But you don't exactly know what I mean because I'm not being precise. Likewise, when I say full tax or no double non-tax, we know what we're talking about, but we fully recognize that we're not being precise. Okay, so in my own paper, I raised the issues of indeterminism and the issue that the effort to ensure full tax, that is to prevent double non-tax, can lead to double tax. And and Leo agrees with these points. So one of the big challenges for me today, right, is as a commentator, is that I actually agree with most of what Leo writes. I'm on the record for that. We've had many conversations about this privately. So that puts me in a difficult position as a commentator. So instead of saying that I disagree with these points, I think what would be most productive for me to do is ask Leo a bunch of hard questions that I can't answer, okay, on points in which we agree. Okay, so let's see if he can answer them, or maybe we can try to think through these things together. Okay, so I think one of the hardest points that Leo has to make here is the one about instrumentalism. So on the surface, he's clearly right. This is just a collection of rules meant to get at more tax. But the obvious question that follows that is, so what? So what if it's instrumentalist? I mean, countries decide their own tax systems. Those tax systems have all kinds of bumps and warts. And if countries want to tax income that previously was lost to hybrids and they make a new rule to do that, so what, right? It may, in a sense, be a blemish on an otherwise, on the clarity of the tax system, but that clarity, if it ever existed, is long lost. So what's one more bump or wart? So another question is, how much of your criticism, Leo, is about full tax as an idea versus the anti-hybrid rules as a particularly bothersome or unsatisfying in your view, instantiation of that idea. So Leo's written an entire book on the anti-hybrid rules, and he's found many flaws in those rules. Is this paper in part really a complaint about how those rules work, or are they really? Do you really have a complaint here about this idea of once somewhere? And can we really make that criticism stick, that the countries are just aiming at taxing somewhere, anywhere, we don't care where? None of these rules assigns previously untaxed income to just anywhere, right? The rules are always using either source or residence. And they're just allocating, they're saying if source should have taxed, residence will, or the reverse. We can complain, and who doesn't, like that source and residence are hard to define, but we rely on these concepts for the whole rest of the tax system. So how wrong can we really go if, in applying a fiscal failsafe, we say if source doesn't tax and residence will, or in the alternative, if residence doesn't tax, source will. And just to be clear, when I say a fiscal failsafe here, I mean just a rule that triggers tax in one state upon the non-payment of tax on a related income abroad in another state. So you have a fiscal failsafe when you have a linking rule that connects tax in one state to tax in the other state, a deviating treatment, so something that under the state's normal rules wouldn't be taxed, but because the item wasn't taxed abroad, you get a change and the other state taxes it. And then you have a normative goal, in this case, full tax. The various BEPS fiscal fail-safes hardly take the view of tax somewhere, no matter where. They are not free-for-alls, despite what people, including me, might have argued in my published papers, okay? We are not talking about the commission allocating large shares of Apple's income to Ireland on not much more than a lark, okay? We're talking about clear, written, prospective only rules upon which companies had ample opportunity to comment. Okay, so what if instead of the anti-hybrid rules, which have various flaws that Leo's identified in book form, okay, monograph length, we look at a minimum tax rule, something like the Globe or the GILTI, or the Biden administration has its way, right? Like country by country GILTI without QBI, which would be even more robust. Or what if we look at something like the Biden administration's proposal for an alternative minimum tax that would look at book income? Can we still complain about indeterminism or instrumentalism in a case like that, which aims at full tax? Or do we have to say that there's a coherent concept there enforced on a worldwide basis that's neither indeterminate nor instrumental, at least not in any kind of objectionable way? Okay, so then we could take a step back, right, and think about, why do we see full tax emerging as a new norm? What motivates anti-hybrid rules, et cetera? And here we have a really simple policy argument, right? It's better that the income be taxed at source or at residence than nowhere. It's not more complicated than that, right? The idea that underlies this full tax norm. And so this goes into the part of the paper where Leo talks about tax planning, and tax planning itself is not problematic. We think about, what is tax planning? Tax planning is maximizing after-tax profits. You want to reduce to the extent possible, you, the tax planner, you want to reduce to the extent possible the government share of the profit, right, without incurring too much real-world costs. A certain amount of this tax planning is not only unobjectionable, it's inevitable. But I also acknowledge that it's not a very socially productive activity. On the contrary, right, it has real social costs because the tax burden is shifted to other factors or public spending goes down. So how you feel about that, just, that's a matter on which people can disagree. But I think it's obvious why at least high tax governments in the world try to discourage it. At the end of the day, we have to remember that the BEPS rules aim to resolve cases, actual cases of aggressive tax planning. And even though we can score academic points by saying that the OECD countries or the EU Commission hasn't come up with a good definition of BEPS or aggressive tax planning, that's not the same thing as saying that aggressive tax planning doesn't exist. And as much as I personally have criticized the Commission state aid case against Apple, because the Commission applied sort of unannounced rules that it seemed to make up as it went along, I cannot credibly claim not to understand just how aggressive Apple's tax plan was, with over 70 billion in stateless income, just undeclared to any country. That breathtaking tax plan was possible due to the hybridity of Apple entities. So at some point, I think we can, as academics, overvalue crisp definition and forget that countries have to buy PPE and vaccines and build roads and school supplies. And so I think, if we allow the academic need for perfect definitions to interfere, or let us forget that the main objections, we have to go beyond just the intellectual pain of having a concept you can poke holes in, and think about the real and genuine pain borne by members of society when the tax burden gets shifted to them from others who may be better able to bear it. Okay, and so now that doesn't address the real issue of legal certainty, which I'll come to. Okay, so that said, I think a more sympathetic case can be made for developing countries which use low tax rates to attract investment. But if we're allowing loopholes to persist for the benefit of developing countries, are we doing it in a way that's really efficient? So we're losing a lot in the process to Ireland or Luxembourg. So if we really want to target relief to developing countries, how about a less blunt instrument, tax sparing instead of an international tax system that's so leaky that vast quantities of profits end up in high wealth, high income, developed European countries that happen to have low tax rates. Okay, so now onto full tax as a new norm. If a norm means only that something is customary international law, then I fully agree, right? That countries feel bound to as a matter of law, then I fully agree that full tax is not a norm. But if we use norm in its ordinary sense, what's typical, what's customary, what's regarded as good in the sense of normatively desirable, that countries follow it as a default rule, or that raising it in a policy conversation is not seen as something done purely in the interest of national self-interest, then I think, as I argued in my paper, we're getting there. So even though that might not be a place everyone wants to go, we regularly now hear officials saying that the fact that there is no tax is in itself a reason to change a rule or to write a new rule. As I note in the paper, there are a bunch of unspoken assumptions that go into that. I don't even know what they all are, right? Nobody's made that clear, but people seem to have in mind something like taxing book income at something like an average OECD rate. But despite the fact that the concept is amorphous and we don't really know exactly what officials are talking about, it seems to be a norm in the same way that the equally amorphous no double tax is a norm. And I think BEPS is a dramatic example of that, and then the globe goes even farther. And now we have an enthusiastic Biden administration on board, which presumably helps the chances of a global minimum tax. Now, I'll just conclude with complexity and uncertainty, and Leo in the paper talks about complexity and really how can anybody be pro-complexity? He notes that the hybrid rules can lead to timing problems. He mentioned it today. Or you need like a more specific ordering rules, for example, between various anti-abuse rules like the interest barrier versus the anti-hybrid rules, and these issues are undoubtedly important. But I would classify them as technical and transitional. Taxpayers and tax authorities are very sophisticated. If there are problems, I would guess that they would be fixed in time. As you may recall, GILTI in the United States was passed at absolutely the last minute before change, in the party that controlled the House of Representatives. It was a bodged job done literally in the dead of night. There were lots of errors in that law, and as problems were discovered, the tax administration made sensible, policy-driven corrections, and that may not work the same way everywhere. But I don't think that, given the world's history with over-accommodating double tax and accommodating multinationals, that countries will suddenly reverse themselves entirely and start believing, and more importantly, implementing, right, policies that leave in place accidental double tax. So in short, coordination increases, it does not decrease the likelihood of getting a single tax result, that is full tax without double tax. More to the point, if simplicity comes at the cost of equity, at the cost of taxing corporate income much less than other types of income, then is the cost of complexity, of simplicity too much, right? Lack of pragmatic rules that could shut down hybrids based purely on the fact that they resulted in double non-tax outcomes resulted in the enormously complex transactions and instruments, right? That the prior system resulted in complex maneuvering by taxpayers. So it's not even clear that on net, the world becomes more complex rather than less complex after we add the complicated rules, if the reaction to those complicated rules is that taxpayers conduct their affairs in a more straightforward way, right? You get more plain vanilla structures. Maybe we get simplification in a real sense from complex anti-abuse rules. So that was a lot. And as I said, it's a bunch of questions that, I'm not sure I can answer, but Leo can, I hope.
Should I react now, Ian?
Sure, unless anyone else wants to add their own questions and make it more difficult for you.
Excellent.
Okay, I guess you're first up. Oh, no, Eduardo would like to contribute. Eduardo, please.
Ruth, Leopoldo, thank you so much for your illuminating papers and presentations. What I can see is that you're offering two different accounts of what the international tax system is. I think that the big question now is the following: can we somehow reconcile your both different accounts? And I find your papers inspiring because I think it is possible to invent a theory of international taxation that arguably may reconcile your approaches to international taxation. So I will, my point is the following, that arguably, I think that the international tax regime is fundamentally the product of the strategic interaction between three oligopolies. Three: the oligopoly of market jurisdictions such as the US and China, the oligopoly of MNEs such as Apple, and the oligopoly of non-G20 hubs such as Ireland and Chile. My point here, my feeling is that Ruth is somehow looking at the international tax system from one oligopoly, the oligopoly of market jurisdictions such as China and the US and Colombia and Thailand. Conversely, Leopoldo is looking at the international tax system from the oligopoly of non-G20 hubs such as Ireland and Chile. And these two, for example, these countries are trying to use their tax system in order to promote their own development. And Ireland, I think, and Chile are both a prominent example of non-G20 hubs. So I think the theory of the three oligopolies could be a way of reconciling your both approaches or accounts of international taxation. For example, Leopoldo is quite concerned about the lack of a clear meaning of the single tax principle. And of course, it needs to be not clear, because the oligopoly of market jurisdictions have to design a regulation that could be accepted by both China and the US. So that lack of uncertainty, I think, is unavoidable if we want to persuade both China and the US to accept it. So my last point is that, okay, it will be very hard to persuade or to invent a regulation that could be accepted by these three oligopolies in the future. So my prediction would be that the future international tax system will be very complex, because it will be necessary to invent a regulation that could be accepted by all these three regulations. I don't know if my attempt to reconcile your, different account of international tax system makes any sense from your end. Thank you.
Thank you, Eduardo. Anyone else want to contribute before Leopoldo gives his response? Leopoldo.
Okay, so this is a fantastic. Let me start with Eduardo's question, which is a very good. It's such a good question that I'm still thinking about. I could say that I'm not sure if I read something about this in one of your articles, Eduardo. It could be this idea of the three oligopolies. It could be.
It is.
Yes.
There is nothing written on that theory, but I'm working on the paper.
Okay. Well, of course, sometimes it's quite difficult to put together. I'm not sure if Ruth and I have such a different way of to see the international tax system. It's more about for example, if we start from the basis that BEPS is reflecting full taxation, I do agree, totally. My argument is more in the direction of saying, shall we use this idea of full taxation as a guiding principle from now on? I don't think so, because of the problems that I tried to stress in the paper. I think your view, Eduardo, is of course way more elevated, you know, and trying to analyze the problem from here, you know, to see what is the mechanic, you know, of powers that are involved in the international tax rules that we have, and that's a way more complex exercise to make, and of course many of the results that we have, all the rules that we have today, are of course part of the dynamics between the different powers that are involved, right? So this is why we have that certain countries, you know, they benefit, for example, more from treaties than others. This is why we are discussing today some rules that are benefiting quote and unquote market jurisdictions, but the real benefit when you calculate it is quite small. So it's very comforting to say we are trying to give a bit of revenues to these market jurisdictions that they cannot get by the current rule, which is true, because the absence of a physical presence prevents you actually to do that. But when you see the amount of revenue that is actually assigned is quite small, so it's very comforting to act in that way. Same with Globe. We say we try to settle this idea that tax competition is something so bad that we need to eliminate it completely. Now the question is, does that mean that countries they will stop competing using other tools different than their tax system? Of course they will do it. They will compete with labor. They will compete with direct subsidies. They will just switch from taxation to other forms of competition. So it is sometimes quite unfair when you see the whole map and the different actors involved, when you simply say to a country with a very small economy that they cannot use anymore the tax system to attract investors. Why? Because we all agreed on that. So now you need to accept it. So that's what's going on actually today. So in that sense, I would say, of course, it's very difficult to achieve a consensus, to put together these approaches, because why we say yes, full taxation doesn't matter what. On the other hand, you have consequences, particularly for certain countries. If I may, and I wanted to answer also to some of the comments from Woods. They were very good comments. First of all, I would like to say true about details, but the evil is in the details. So sometimes we tend to forget that and say, let's talk about that later, right? So at the moment, let's agree that we need full taxation because that's what we need, and then we see how we realize what's going on. You know, particularly looking into the details. It's more or less what the OECD does or has done since the BEPS project in itself, right? I think that idea is quite comforting from the perspective of the ones that we try to impose it, but I couldn't say that creating new situations of double taxation it's just incidental. You can prevent that if you look into the details, right? So if we are going to accept full taxation, let's also accept all the normative limitation that are attached to this idea of full taxation as well. So that's what I'm saying, and that means, you know, that that maybe full taxation in itself, it doesn't work as well as we try to see it. Instrumentalism, so what? Yes, so what? I have to say, if instrumentalism, indeterminism, over-inclusiveness, would put the three of them, and I would say, so what? Because none of them are part of a, let's say, an absolute analysis to say tax rules, they have to be determined, they have to be not over-inclusive or instrumentalist. No, we have plenty of that in the tax system, but particularly when we see this idea of taxing all of a company's income somewhere, is when indeterminism is important. Let me give a different example than the one I gave in the presentation. So, of course, again, I will take the issue of hybrids and interest limitation rules. Right? So one of the rules in the anti-hybrid rules is an interest limitation. Is denial of a deduction if there is no corresponding inclusion of income in the other country. So to avoid, of course, the generation of double non-taxation. Interest limitation, they act in the same way, right? So deny a deduction in order to keep, certain equilibrium within the amount of debt and equity in a company. What is the difference between these two rules? That the interest limitation rules, generally they comes with the possibility to use that amount that was denied in year X in the subsequent years. Why? Because you have in mind the idea of ability to pay. In the case of the primary response, the rule doesn't come with this idea of what was denied in year X. You can use it in subsequent years. So when you think about, okay, I need to see the interaction of this rule. What rules should I apply first? It's very easy to say, well, lex specialis, anti-hybrid rules, I applied that first. Lex generalis, I applied, then interest limitation rules. From a principle perspective, you could say exactly the opposite. You could say, I will apply first the rule that denies a deduction, given the possibility to carry on the amount that was denied for the subsequent year, particularly because if you solve the mismatch, but for any reason, that mismatch was not a real mismatch, because when you took 2 years, 2 consecutive years together, the double non-tax concern simply disappear. At least you have the taxpayer with the possibility of, or let's say, not affecting the ability to pay of the taxpayer. Of course, the OECD suggested that we should go in the opposite direction, that we should apply anti-hybrid rules first. So again, that's for me is a demonstration how when you have so much in mind that we need to apply certain rules in a certain way, and this excessive pragmatism, you achieve some result that are not entirely consistent. The same happens with the idea of ensuring that income is taxed somewhere. Think about the role of withholding taxes. I deny a deduction in a country, which is the same that happened not only with anti-hybrid, but also with the anti-tax payment rule with Globe. I deny a deduction in a country, but when it crosses the border, I apply a withholding tax. Am I taxing the income once? In my perspective, yes. Income is taxed once, and actually that withholding tax economically is a burden of the payee, not a burden of the payer. But again, the OECD is considering that that's not an inclusion of income, because when they think about inclusion of income, they think about what happened with the corporate income tax in the country of the payee. So they completely disregard what is the role of withholding taxes in a real world, right? So that is again why I consider that we should not simply say forget about all the details, because in those details is where we find the same inconsistencies of the concept. Full taxation as a new norm, I'm not so sure if we are better off if income is taxed somewhere. And this is because and here I would say we have a different way with to see the international tax system, because for me it's like we still live in a world with countries that they decide what to do and what not to do in terms of taxation. They are sovereign to decide on that. So even if you even if countries they agree to limit that sovereignty through tax treaties, they do that, but the final word is actually given by domestic law, not by the treaty, right? Because treaties are simply assigning taxing rights. So if we go into a simple example of saying, well, there are payment of royalties from the source country to the resident country. So to the extent that the guy who receives the royalty is the beneficial owner of the income, exclusive taxing rights to the resident country. If the resident country doesn't want to tax that, what is the result? Non-taxation. How can we say, just so in absolute terms, that this situation is not the most beneficial, when both countries agreed on that, agreed to limit the sovereignty to tax that particular item of income, and the exercise of that right, again, it depends of the same sovereignty. So I could agree that a different story is when you have situations of abuse of treaties, right? And that's that in order to achieve non-taxation altogether, of course, then taxing somewhere makes sense. As it makes sense as well to say why we relieve only juridical double taxation when we talk about treaties and not economic double taxation. Why we make this distinction when double taxation is just double taxation, right? And now, for example, when we have the application of the saving clause, what we will have is situations of economic double taxation. What the OECD says, no relief, no obligation for the countries to relieve double taxation. For me, that's a contradiction, because if you are concerned about both sides of the single taxation idea, right? And we should forget about those kind of distinctions and say, well, in such a case, relief should also be granted. Okay, I want to use all the time. I would like to also hear what Ruth and others have to say. So that's all from my side.
So,
Okay, that's wonderful. I think these are really, we're getting a real dynamic of the challenges between the different arguments. Next.
did you
Ruth,
want to respond while others are getting on the queue? I don't see the queue.
Sure.
I don't know if that's, is there a queue?
Isabel, do you want to have a?
Hi, hello everyone. Hi, I just want to say thank you for Ian and Eduardo for inviting me to participate on the seminar, and also to say congratulations for Ruth and Leopoldo, because the reading of both of your papers are amazing, how they complement and how they go through different points of view. It's like an exercise of our our intelligence, in a sense. So what I read in both papers, what came to me is that both of you agree that the problem is distributive rules. How to solve this problem, considering full taxation. But what came to me is that the problem is really exists, and it is what should be addressed, is when we have a relationship between two countries, that we have a haven in the middle. So for me, there is we are not talking about full taxation when we have a developed and a developing one, because then even if the developing one give a subside or even is not taxing to attract FDI, that's not a problem. That's part of the, let me say, the health competition. But the problem is the unhealth competition, which is when we have a haven in the middle. And I think the thing is, reading both of you, what I concluded is that we still don't know how to solve this equation. Even if you have a developed in one side and a developed in the other side, it's fine. A developed and a developing one is also fine. Two developings is also fine. If they don't want to tax because they want to attract and to invest one in each other, no problem at all. But the equation is, and reading both of your papers, that's what came to me, is we still don't know how to save when we have a haven in the middle. I'm challenging both of you.
That's an
We've lost you, Leopoldo. Still can't hear you. Sorry.
Just for your reference, Isabel is speaking from Sao Paulo, I understand, Brazil. Is that right?
Yes.
Ruth, do you want to say something while Leopoldo fixes his sound?
Sure. So thanks. It's a terrific question. So yeah, the havens are the sort of the defectors from the regime, the Irelands and Luxembourgs of the world, not to beat up on them too much, right? But these are the countries that are creating the loopholes, designing their laws to create mismatches. And, you know, so the question is, you know, like, how do you cut out the defectors? You know, and I think to some extent the anti-hybrid rules do that because of the redundancies in them, right? So the idea that they have not only a primary rule, but a defensive rule, so that you only need one of the legs of the transaction to have the anti-hybrid rule for it to work, right? So you don't need, if you have, let's say you have developed country, haven, developing country, haven, developed country, and that's sort of the order of the subsidiaries or the order that the transaction is going, the payments are flowing. You don't need the haven because you could have the developing country have the primary rule and you can have the developed country have the defensive rule. But even if you only had one of them have one of those rules, the hybrid still gets shut down. So the ability of the haven to interpose itself between those two countries and skim, right, is lost. Likewise, the minimum tax does the same thing by another mechanism. The minimum tax says, you know, attention, I don't care what happened abroad, right? But if you didn't meet tax rate X, there's going to be more tax to pay. Right? And you can do that on a source basis, and you can do that on a residence basis. And that'd be, even if there are countries, if you do it at both ends, and even if there are countries in the middle that would like there to be no tax collected, they get shut out. So I think, you know, I mean, they may not work perfectly, but the countries are coming to solutions designed to prevent defection. And, you know, Leo said in some of his comments earlier, you know, in the treaties, you know, countries agree that, you know, this state or that state has entitlement to tax a particular item of income. And if one of those states doesn't exercise its entitlement to tax, why is that a problem? And I think that's right. You know, if they agree and it's just between them and they've agreed, you know, resident state will tax and resident state decides to exempt, no problem. That's not, you know, a violation of the single tax principle or the full tax principle. The problem is when it's unconsented. It's either accidental, right? Because the government that put into place the policy that the taxpayers taking advantage of wasn't paying enough attention, as in the US check the box rules. And by the time people in Treasury figured it out, it was too late. okay? And the companies wouldn't let the US get rid of the check the box rules, right? Or because, as you suggest, Isabel, there's a rogue country interposing itself and creating a wedge in the bargain between the source state and the resident state that has the tax treaty. So I don't know if Leo's mic is working.
Can you hear me now?
Yes.
Okay, good.
Great.
All right. I could agree with the idea that Isabel was posing about that everything surrounds the lack of a distributor. This is precisely what I try to do, and unfortunately, I have to say you really got to the point, because I in my paper I'm not pretending to give any answer to that, but it's actually the most important question. What I'm trying to say is instead we have to be careful, because for some people full taxation may appear as itself as a distributive rule, and it is not. And that is what concerns me, and that's what I'm always saying. You know, the concept is indeterminate, because for some people taxing somewhere doesn't, let's say, answer the question without attending to what is the particular distributed rule that we are applying. What else I can say? I totally agree with you. I hope the next paper actually addresses the issue. Maybe the next paper I have to write it with Ruth, and we have to agree on that. What is the distributed rule that we need? But is fundamental, because it is part of my criticism as well. Full taxation gives you the answer about the collection of revenues, but doesn't give you the answer about the distribution. So this idea, this economic idea that you first collect and you then distribute, is not a sacred mantra that you have to apply always. It's more important to have first a distributed rule, and then once you have it, you might agree on whatever you want, including the idea of taxing full.
Could we come back to Eduardo's question?
Sure.
So, Eduardo, you're the paradigm you set up, where there's sort of, three hegemons, right? So there's the market countries, there's the developing countries, and then there's the smaller states, and then there's the multinationals. Can you maybe fill that in a little bit more? Like, so how does having the multinationals there, how would that add to the account that Leo and I are describing here?
Thank you very much, Ruth, for your question. I could say that the theory of the three oligopolies, three. Mm-hmm. First one is M&Es, multinational enterprises. The second one consists of market jurisdictions such as China and the US. And the third one, non-G20 hubs such as Ireland and Chile. Mm-hmm. This third oligopoly is in the business model of this third oligopoly is to basically to link M&Es with market jurisdictions. And I think the Apple case is a wonderful example of that. Ireland is fundamentally linking Apple with the European Union, or with Europe. So what I can see is that in the 20s, the oligopoly of M&Es requested the League of Nations to do something about the problem of international double taxation. So the request was submitted from the International Chamber of Commerce from Paris, and the oligopoly of M&Es requested the League of Nations to do something on how to solve the double taxation problem. By 2015, the oligopoly of market jurisdictions, such as the US and China and similar countries, requested the G20 and the OECD to do something to alleviate the problem of international double non-taxation. So what we can see is that at the end of the day, as far as I can understand, Ruth, is that we are fundamentally talking about how to redistribute, redistribution between fundamentally non-G20 hubs such as Ireland and market jurisdictions. So this is, I think, a strategic game. And what my way of reconciling your theory with Leopoldo's theory is that you are speaking from the perspective of two different oligopolies. My understanding is that your seminal paper, The Transformation of International Law, published in the American Journal of Comparative Law, you are fundamentally looking at the system from the perspective of the oligopoly of market jurisdictions. And in order to persuade China, the US, and similar countries to agree on a regulation, okay, that regulation is the full taxation. It is very obscure, but it is good enough to have both China and the US on board. Conversely, I understand that Leopoldo is talking from the perspective of non-G20 hubs, such as Chile and Ireland. That's my understanding of the game, the strategic game. I don't know if this makes any sense to you, Ruth.
So what is the role now of the multinationals? What are they asking for in the present day? So now let's say we accept your setup that what we're engaged in now is we're trying to shift income from the non-G20 hubs to the market states. What do the multinationals want?
Okay, let me give you an early example to answer your difficult question. You may remember that, Mitchell Carroll, he produced the Carroll Report in 1933, and the controlling shareholder of the largest US multinational, Rockefeller, funded that study. So my point here, my theory here is that M&Es are somehow influencing market jurisdictions and non-G20 hubs on the evolution of the international tax system. So Rockefeller basically, contributed with about $2 million in 1932, 1933 in order to fund the Carroll Report. Because the League of Nations simply had no money to fund that report. Rockefeller played that role. Going back to a current example, my feeling is that the M&Es, the oligopoly of M&Es have been blocking any attempt, at least until 2015, to address the problem of international double non-taxation. But because of the financial crisis and now COVID, the bargaining power of M&Es has been going down. And now what President Biden is trying to do is fundamentally to introduce a rule in the international tax regime in order to prohibit international tax competition or to substantially limit international tax competition. This idea based on the sales principle. So what the US is trying to do is to limit tax competition in order to somehow limit the rent that non-G20 hubs have been enjoying over the last over 60 years. So, and that I think is consistent with my British tax review paper, according to which the hegemon normally wants to embed a rule into a regulation in order to centralize the political power. And another example to ground that theory is, for example, the current Digital Market Act that is being discussed in the European Union. And it also includes a rule. So both the European Union in the area of the digital market and the US in the area of international taxation, both are trying to embed a rule in order to maximize their own interest at the expense of, for example, non-G20 hubs in the international tax regime and gatekeepers in the area of digital market. So what I can see is that normally, hegemons wants to embed rules in order to centralize the political power. I don't know if it makes any sense to you, Ruth.
Yeah, it sounds really fascinating, and I have the sense that you're leaning back to look at a whiteboard on which you've answered all the questions in international tax and unlocked all the secrets, and I kind of want to see this whiteboard.
Thank you very much.
No, it's really it's a fascinating idea, Eduardo. I think of course I cannot give an answer now, but it would be great to read the result of this, because it sounds again fascinating. You know, how you are trying to mix, you know, the different powers involved, you know, in the creation of the rules that we have in the international tax system. But may I share a bit my screen, Ian, because I wanted to go back to an example.
We're getting to the end of our time, but please go ahead.
Very, very, very brief, just because I wanted to go to this example. Because one of the things, and that we need to look at full taxation, is that the idea tries to go into this concept of taxing somewhere all of a company's income where factors of productions are located. And if we take the example of Globe and how it applies, or it will apply if it is implemented worldwide, it endorses the idea of taxing somewhere, but not necessarily where factor of productions are located. So if we think about this very simple example, and we have the income inclusion rule. The income inclusion rule is telling us that the ultimate parent in country A has to actually collect what is not sufficiently taxed in the other country, right? Or we apply then the undertax payment rule. But the point is, what is the nexus? What is the link that triggers that taxation in country A if, for example, all the shareholders of that entity A are somewhere else around the world, but not in state A? Or what happened, for example, if you have the intangible that is generating the payment of royalties, which is generated in any of these countries, A, B, C, or D, it's actually in country X. Why we should give country B or C the possibility to tax, or even country A, if it's the ultimate parent, the possibility to tax? And this is, for me, the best demonstration to show that full taxation, if addressed, if endorsed by the current international tax rule, is applied like it is in Globe, it will bring us to tax somewhere, but not necessarily where factors of production are located. Let me just stop that share, and I don't know if you would wants to reply fast to that.
Ruth, do you want to have a final word on that?
That seems like a great place to end to me.
I mean, yes, lots of meat here that we can discuss in the future. And thank you so much to Leopoldo and to Ruth for presenting these papers. I mean, Ruth has offered us the idea that the BEPS project marks a change in the direction of the consensus in international tax regime. And Leopoldo has explained wonderfully the way in which he sees that as offering elements of incoherence and uncertainty towards the future. And the way in which we will reconcile these is something still to be determined. But thank you so much for joining us and for presenting this, and to everyone for coming along as well. And finally, I would also like to thank Grace for her wonderful support in making sure that this actually happened and that we have a live system. We are recording this. We have recorded it, and both Ruth and Leopoldo were enthusiastic about that idea. So we will make this available to the mailing list in due course once we've managed to process it and figure out the technicalities.